Good evening, everyone. Happy New Year and welcome to our first live stream for 2024. And congratulations for spending this cold evening and attending Financial Independence Planning's 2024 live stream. We truly are looking to the future for 2024, the year of the dragon. I'm Carolyn Cho. I'm also the Chief Marketing Officer and one of FIP's senior financial advisors. We have a room full of clients and guests tonight. We're all very excited for a lineup of our speakers. We have a wonderful program, and your attendance tonight, taking the time out, shows you're serious about making smart choices about your money. Before we bring on our speakers, I'd like to first make sure you all are, for many of our guests tonight, that I introduce Harry Keller, the founder and CEO of Financial Independence Planning. For over, well, actually 30 years, FIP has helped individuals to make very smart retirement decisions. And we've also trained financial advisors to continue to help those individuals, their families, and their friends. Harry has been named Best in State by Forbes for the second consecutive year. Today, FIP has a staff of over 25 team members to help families stay on track to their goals. In addition, Harry has been named to the Financial Times list of top 400 advisors in the U.S., both in 2021, 2022, and Philadelphia's five-star management every year from 2014 to 2022. Tonight, we have a cast of great speakers. Brian Gennard joins us from Columbia Threadneedle Funds, which manages over $608 billion. Just think about that. Additionally, David Spagnoli, Associate Director at Wisdom Tree Investments, that manages $99 billion, will be introducing renowned Professor Jeremy Siegel. Dr. Siegel is no stranger to us in the Philly area. He's the Russell E. Palmer Professor of Finance at the Wharton School of the University of Pennsylvania and in Philadelphia, Pennsylvania. And he's often on many talk shows and CNBC, and I'm sure his name is a household name to some of you. He's author of the best-selling book, Stocks for the Long Run and Future for Investors. Without further ado, let me pass the floor to Harry Keller.
Hello, everybody. I'm so glad to see some of your smiling faces. If any of you want to turn on your cameras, we can say hello to all of you. Happy New Year. I hope that wish you all a happy, healthy, and fun New Year, which is important. And I want to personally thank you for trusting us to help you with your family's financial decisions. Also want to thank Carolyn for her introduction and all the hard work that her and Michael O'Donnell, the new marketing manager, have done to put this live stream together. We have several live streams this year. We just got compliance permission to post them on the website. So you'll be seeing a place on the website where we'll list all the live streams so you can share the information with your family and friends. Also, I want to thank Jeremy Siegel and Brian Gennard for presenting tonight, and their companies, their respective companies, for their support throughout the year. Keeping up with economic changes is a very important part of total financial planning. Of course, individual goals, time horizons, risk tolerance, guaranteed incomes, assets, taxes, insurance, and estate planning are also a very important part, and that's the things that we look at on your regular checkups. Operationally, we're back to work in both our Conshohocken and Lansdale offices. Fortunately, with Zoom, we've been doing virtual checkups and annual reviews now for over 2 years, and that's helped to significantly improve the effectiveness of both our virtual and the in-house meetings. So I want to thank also the FIP financial advisors and client services professionals who've worked hard to continue to provide the high level of service. Again, we appreciate you all, and we want to continue to work to improve our services to you. And thanks again for being loyal clients, and many of you for over 20 years. Some are going on 30 now, and for the many referrals to people like yourself, your family and friends. So thank you. So I'd like to introduce my son, Jared, who's been a certified financial planner for over 5 years. He started, when he was 8, we say, but he really, after college, he started full time, and he worked his way through client services to senior financial advisor, attained his licenses, and became a CFP. He's became the manager of new business and now is president of FIP. I feel very confident that he's going to be able to take the company forward, and I'll be here to coach him. We'll hear from Jared, who'll talk a bit about our process and our services.
Good evening, everybody. Happy everybody could attend. Nice to see a bunch of you guys on here. As you know, I've been seeing a lot of you in person. I'm that annoying advisor who says, you want to come on in the office? Come on in. I miss seeing you guys in real life. So just want to give a quick shout out. One of our clients' birthdays today. Happy birthday, Jim, celebrating with his grandkids. So no better way to celebrate than with family. Before I jump in, I just want to, it's a start to 2024. Just want to take a quick second to reflect on last year. And I really think at FIP, we had a tremendous 2023. And how do I measure having a great year? Continuing to help all of our clients have confidence in their financial plans, continuing to encourage them to enjoy their lives, continue to travel, and know that they have a trusted team by their sides, looking out for their best interests regularly. Our service model has gone up tremendously. We really focus on making you guys feel great and confident, and we promise only to look for new ways to improve our service model and be even better advisors and service to you guys this year. So thank you for being valued clients to all of us. And of course, thank you for all the introductions.
Yeah.
So we believe a sound financial planning process should free up your time from worrying about money to enjoying all the things in life that are most important to you. And I can confidently say that's what our process does. By using one of the top financial planning softwares in the country and delivering customized financial plans for each of our clients, we give our clients confidence that their assets will last the rest of their life and they can maintain their lifestyle, or we show them what they need to do to be on track for their assets to last the rest of their life. And most importantly, as you guys know, we monitor the plans with you regularly, because our goal is to not give you confidence today, it's confidence for the rest of your life. So our mission is to help our clients become financially independent by helping them make smart financial choices. The financial independence planning process enables our clients to approach their future with clarity, confidence, and capability. Clarity's with that financial roadmap. I know everybody on here has one, and believe me, one of my favorite parts of the financial roadmap is bringing it up during those annual reviews. And we go over what's important about money to you and showing that we still are on track to living up to all the things that we said that plan was going to do for you, that you'd have confidence, that you had security, or that we'd help you consolidate things, you could spend time with your family and travel. And confidence is that comprehensive financial plan that we put together for all of our clients to give you confidence that you are on track to your goals today. And as many of you know, reviewing the plan is one of the first things we do at all of our reviews. And it's really the most powerful part of our process. It's really what separates us and makes our firm unique. Many financial advisors call their clients, talk about returns, talk about the economy, but what do we do? Why are we different? We use that software to show you that you're on track to your long-term goals, and most importantly, with capability, we monitor that plan regularly and make adjustments along the way to have ongoing confidence you stay on track. One of my favorite pictures, look at what a robust team we have and continuing to grow. We have 10 financial advisors, 13 client service representatives. My favorite thing to brag about is the in-house accounting firm, in-house estate planning attorney. I had one of my clients call in the other day for a friend. Said, my friend has a estate planning question. I said, no problem. I unfortunately don't have all the answers, but what we do have at FIP is all the resources, and we utilize them for all of our clients. So after a phone call or two, I was able to assist one of my clients with a estate planning question. And again, that's why we're different also. We're not just here to help manage the assets. We help with tax planning. We help with estate planning, making sure your insurances are lined up. So we really take a comprehensive approach so your total financial household is all organized. And again, that's exactly why we're different. Many people that we meet have investments. But again, your 401k or your brokerage account or the cash value in your life insurance policy, not one of these relationships can give you confidence that you can retire and maintain that lifestyle you want. But by working with FIP, by working with comprehensive financial advisors, we oversee all of your incomes, all of your expenses, and as those change throughout various points in your life. We understand your risk tolerance, your time horizon, and we make adjustments to those again as you go through different phases of your life. And most importantly, make sure that as you go later stages in life, that you have the adequate assets and the adequate strategies to have that money last. Our financial planning process, as you guys all know, we're not on the news, we're not on the radio. We have a phenomenal group of clients, and all we ask and all we look for is introductions of people just like yourselves. And that introduction always begins with step 2, an informational phone call, just to get a better understanding of what your relationships look for when working with a financial advisor. And we explain our planning process. And if they'd like to set up a complimentary consultation, we move forward and put together a plan for them. We, of course, do that financial roadmap and put together a comprehensive financial plan. We never ask for any payments. We just ask if the recommendations make sense. The relationship would move forward with us. From there, number 5, our alignment review. We get new clients logged on to our great technology. As all of you are familiar with, great online access to view your performance. Aggregation website if you want to track your net worth. DocuSign when we have to do paperwork. And then, of course, our regularly scheduled checkup calls. Just as important as doing a checkup call to review your accounts, what's just as important to us is building that relationship. You got to remember, we're in the business of taking care of you guys. So when we get to talk to you 3 times a year, twice a year, it's really important that we take that first 10, 15 minutes to see how you're doing. See that you're enjoying your retirement, you're spending time with your family, you're recovering maybe from any ailments, and be supportive to you guys. And of course, we review that financial plan to give you confidence you're on track to your goals, make any adjustments and review the accounts and make any adjustments there as well. And why we are unique is events just like this. We run fun and educational events for all of our clients because, again, we don't pride ourselves just on our service, but on our experience. So I just want to thank all of you for coming in. I want to thank our marketing team for setting this up. We've got phenomenal speakers. And as I said, we're looking forward to a great 2024 of delivering even better service and experience to you guys. Carolyn?
Well, I'm not going to, I'm the only thing holding you back from the rest of the seminar. So I'm going to hand it over to Brian Gennard from Columbia Threadneedle. Tell us the wisdom of managing a $608 billion fund.
Well, thank you for inviting me to be one of the 2 keynote speakers, myself and Professor Spiegel. I really appreciate that. Some of you have seen or heard me before. I think I have been invited at least in person. And if you have seen me before, you know, like I like to walk around, I'm animated, sometimes I tell jokes. So I'm a little bit more under control. We're in a time constraint. I've got slides and I'm in my office, so I can't walk very far, and there's a camera on me. Sometimes I have the Gennard family looking at me from between the French doors, but hopefully that won't be too distracting. So thank you for being here. Thank you, Harry, Jared, Caroline, the team, everybody on the team to be here. Your firm is very unique. I think in the 15 plus years I've known you, I could definitely say FIP is a very unique firm that we work with. You're very fortunate to have these folks on working on your behalf. I do really like that big picture. That's my favorite to see of the team, everyone there, in particular the light blue socks that Jared has on. Those are my favorite too. So with the slideshow, the 56 slides that I normally do on our capital market outlook, there's 2 of us, so I want to go through and not do duplicates on slides. So I cut it down to only 20. We'll go through them fairly quick, so I appreciate that on the time. So with Columbia Threadneedle Investments, we are this large global asset manager. We are located, North America headquarters is located up in Boston. Threadneedle is our international-based company located in London on Threadneedle Street, hence the name. And we have 16 other countries that we have offices in across Europe and Asia. So we have financial analysts all over the world that kind of help us and guide our clients who are financial advisors kind of throughout the year. So with that, let's do a little review. So 2023 is in the rearview mirror. It happened, and these numbers show that we should be pretty happy. The top line are the fourth quarter numbers, the last 3 months of the year. The bottom lines are the 2023 numbers for the full calendar year. So with the fourth quarter's numbers, whether you realize or not, and you will in your reviews, we had an excellent ending to the year. Absolutely fabulous returns across all asset classes. Even U.S. Treasuries were up 5.7%, which was the kind of the low mark, with the one exception, commodities, being negative 4.6. But we saw a kind of a 6 to 11 return in the last 3 months of the year. So make sure you look at your statements, because they definitely changed in September. Now, as a year to date or the calendar year, wide ranges, a 26.3 return in US stocks to the one negative, a minus 7.9 on commodities. Do we remember 2022? If we do, I know it seems like a long time ago, but commodities was kind of the lead returner in a year like 2022. So again, some things perform well, some things take a break. Last year, 2023, commodities took a little bit of a break, and we see those numbers represented in these charts. So a well-diversified portfolio, and that's an FIP portfolio, choosing whether it's a growth or moderate or all the categories that you have as an option for you. A diversified portfolio did very well calendar year wise, and in particular in the fourth quarter, when a lot of these returns kind of played catch up and gave us real positive numbers. So if we go a little bit more specific and we look at style classes, the growth versus value story. Fourth quarter again on the top, and year to date down at the bottom. Fourth quarter, again, excellent across all asset classes, double-digit returns in most equities. Year-to-date returns, excellent also, but a huge difference between a large growth portfolio or a 42.7 return versus value that might have been 11.6 or a large value 11.4. So a big differentiation in the year returns. In a fourth quarter, we saw a lot of the underperforming asset classes play catch up. Again, very in particular, a diversified portfolio that you all have at FIP did very well in a year like 2023. So when we look at now going forward, and we do this on a 6-month basis, so every 6 months we update this. This is our global allocation team. So we look at our 5-year forecasted returns. We look at each asset class, whether it's US equities, emerging market equities, investment grade bonds, and we look at current valuations, and then we view it as a 5-year forecast. Again, so this would be asset class performance. This was slide 2. We talked about this. If we can go to slide 3, this was the style returns from, again, quarter 4 at the top, year to date at the bottom, which was calendar year 2023. You can see the differential between returns. We go to slide 4. This was our 5-year forecasted returns. Again, this probably looks better than looking at the original blank screen. So this, again, we update this every 6 months. 5-year forecast, if we were in a diversified portfolio going forward with a cash return forecasted of 4.2 and the high point of a US small cap stock of 9.3, if that's the best and then global sovereign bonds are the worst at 3.1, you can see that's a very positive 5-year forecast that we have. It's slightly lower than where we were 6 months ago. As you can see, what we just went over in the fourth quarter, we had really, really strong returns in the second half of 2023. So we've reduced our 5-year annualized returns going forward because we got some of that extra stuff last year. But this is an excellent, we're very positive. It's not always this positive. So a diversified portfolio, including commodities, is a very positive number. The only number that kind of surprised and went up a little bit was the US large cap stocks at 7.8, a little bit higher than where we were. We're very positive on US cap stocks. Okay, so, one back, page 5. Okay, so one thing about US growth, and this is one that we keep bringing up, economic activity is definitely slowing. That's not a bad thing. We've come off some really strong growth in the last couple quarters. So economic activity is definitely slowing. Business activity has gone below trend. Activity indicator has gone slightly below trend. Consumer activity is still relatively strong. We all know that consumers and demand for consumer services has been very strong. If we look at inflation, the one thing that hasn't come down as fast is the cost of services. It's because we are all demanding more of those. We're going out to dinner. We're going to football games. We're going to a Taylor Swift concert, or some of us. We are watching Oppenheimer and Barbie in the movie theaters, and we're going to that summer European tour in Italy. Americans have been spending on services. And since the US economy is a 70% service-oriented economy, we are in the right time and the right place. It's a very strong thing for us in the US. So the US economic kind of picture has been clearly the prettiest house, maybe in an ugly neighborhood. We deserve a premium because our consumer has still been spending. Now, we're going to find some data on credit card debt, historical high levels now in credit card debt. We've seen defaults starting to move up on credit cards. Okay, so that we're looking at some of that data now, but the trend line is the US economy is slowing. Next slide, page 6. The New York Fed uses a recession model. So we look at this data, and the data predicts the probability of recessions. Above 25% predicts recessions. End of January now, we're in the kind of the 50+ range in terms of the probability. So it's come down a lot. Peak was 70% last May. So it's come down a lot. However, it's still showing a probability. Doesn't mean it's definitely going to happen, but a probability 6 to 18 months out that there could be a recession. We are at Columbia, we are predicting kind of a soft landing. We've heard all these terminologies been kind of thrown out there: hard landing, soft landing, no landing. So no landing would be no recession. Soft landing would be kind of bounce off the bottom for 2 quarters. Some people feel it, some people don't, but kind of a very mild soft landing that the Fed can kind of orchestrate. Hard landing, we all know that. That would be a recession that we would feel. We believe that we can avoid that in the current climate, especially if our consumer continues to be out there. So keep buying things and going places. Next slide. So if we look at the big picture on recessions, the duration of them, since World War II, the average duration is 10 months. We have the shortest, that was in 2020. That was clearly when the government told us to go home. That was the shortest. We have See, someone laughs at that. Thank you, Carolyn. And we have the longest. We call that the Great Recession. We call it for a reason, because it was the longest and one of the most difficult recession that we've gone through kind of in modern history. So that's the Great Recession. But the average is 10 months. On average, we are told by those folks in the padded rooms when a recession actually begins, 8 to 12 months. So we may be out of a recession, at least an average one, by the time they tell us that we've been in one. So it's not something that we are dreading or looking forward to. We're trying to, as a global asset manager, predict. We're in the cage that a soft landing can actually be orchestrated this time. And it's probably in the cycle we are with the Fed. Professor Siegel is going to talk a little bit more about the Fed. So we kind of took out those slides so he can have those. A little bit more difficult, so I passed that off to him. But we're an advantage. The cycle has ended from raising, which is trying to slow us down. They're clearly in a pause. And if we go into a cut mode in terms of the rate hikes, that would be a much more accommodating stance for the Fed. And since the market is predicting that, that should be helpful if we're predicting economic activity slowing down. Next page. Okay, price to earnings. Again, we make this sound more complicated. We can try to make this sound as simple as possible. This is a very exciting chart, as you can see, hopefully. S&P price to earnings ratio is on the left, and the 10-year treasury or bond yield is on the bottom. This is an XY, if we remember when we were in school. So price to earning levels tend to rise with lower bond yields and vice versa. So if we're looking at a 10-year treasury in the 4+ range, then that would give us a kind of a fair valuation on the S&P 500, about 15. Okay, we're a little bit higher than that. Let's say we're around 20. So we are at a premium. So US stocks are trading at a premium. Our PE ratios are higher than a kind of a neutral stance or fair valuations based on bond yields. Okay, I would say if the US economy was growing strong last year, we would deserve to be paying a premium on our stocks. Europe had bouts last year being in a recession. Well, they probably deserve to be trading at a discount. They are in many cases. China has definitely been in their version of an economic slowdown. Well, they're clearly have been trading at some discounted levels. They should be. So when I jokingly said that we are the prettiest house in an ugly neighborhood, well, that makes sense. There is a war going on in Eastern Europe. There is a conflict certainly going on in the Middle East. There may be more. There's definitely a random ragtag group of people firing missiles in the Red Sea, which is a container port of ships going directly to Europe, where they may have a supply chain disruption. Well, that's not going to help an economy that manufactures things and exports stuff. So there are concerns why other areas around the globe are trading lower valuations or lower or discounts. Well, there's clearly reasons for it. There are reasons why the U.S. equity market is trading at a premium. We deserve to be. And we can make it sound more complicated sometimes, but it comes down to that. And the fact that we have a very strong consumer right now. Okay, next slide, please. So we always bring up dividends. One of the negative factors in the S&P 500 last year was dividend-paying stocks. We had a momentum with growth stocks last year. We can even see where the leaders were. They were generally some tech growth companies that were leading that. But from a history standpoint or a historical standpoint, dividends matter. And in some decades, dividends matter very much. And we break it down by the decades, and then we kind of go in year by year, 2020, 2021, 2022, 2020. So you see either the appreciation in the stock market came from price movement, or you see a 2022 where the movement was because of that price movement from a negative perspective. Historically, dividends make up kind of 3/9 out of that out of that number. So it's not a 50-50 total return number, dividend and appreciation, but much closer than we have seen in kind of recent memory. One of the opportunities in a year like 2024 would be, especially with economic activity slowing, is some of the best companies on the planet pay consistent dividends and may outperform in a kind of slower economic environment. So dividends do matter. Sometimes they're different than others. 2024 is one of those years that could really matter and strengthen returns of individual stocks. Next page, please. So this is the fun page we like to show because some people don't believe this. If you take 9 stocks out of the S&P 500, and hopefully you can see those 9 companies, Eli Lilly, Tesla, Broadcom, Alphabet Soup, Amazon, Apple, Microsoft, Meta, and NVIDIA. That contributed to 101% of the S&P 500 index gains in calendar year 2023. So if you looked at the S&P 491 index, that would have been negative. So that's not normal that we have 9 stocks that are represented to over 100% of the return of that index, which is a passively managed index. You don't, I guess you didn't need all 500 if you're going to get the returns from these folks. But that was a very unusual year. So when you look at some of the portfolios that FIP designed, that just shows how well they did when you look at these 9 stocks leading the way in the S&P. So this underlines why you diversify, why you use a financial advisor team to manage your money. It's clearly a lot less risk owning a diversified portfolio than owning 9 stocks. Whether they did better than you or not, 9 stocks are, you're taking some chances. They can all do well. Maybe they all not do well in a particular year. But last year was one of those years where they led the way. Next page, please. So big is also getting bigger. So the market value share of the 5 largest stocks in the S&P 500 it's now approaching 25% of the S&P 500. So that big benchmark with 500 of the largest companies in it in the US, 5 of them are making up almost 25% of that market value. That's huge, that's massive, and the big are getting bigger. We can view that as a good thing or as a bad thing, but it's certainly not a diversification thing. Those 5 companies can have a huge outlier in terms of risk or return. If we look at what they make up in terms of earnings of the S&P 500, it's a much lower number. So then their market value is a big chunk, but not necessarily their earnings as a percentage of the S&P 500. There are some industries that are woefully underrepresented in terms of their earnings contribution versus kind of their valuation. They're very undervalued versus their earnings potential or make. So that's an active manager looking for that unique company that for some reason things have passed them by, but their earnings numbers are very, very positive. Might be a dividend, for example. Next page. So artificial intelligence. I kept this slide in here because everyone always wants to talk. We used to talk about gold, and then some people ask about cryptocurrency. Artificial intelligence is very, very popular discussion point at this point now. So lots of opportunities. You can sense how some of the top performers last year were because of their artificial intelligence technologies. So what is AI? Well, it's not a product. It's not a phone. It's not a pen. It's a productivity thing. So that's a huge opportunity. It will increase productivity of anyone or any business that chooses to use it. Improvement in healthcare. It's going to analyze massive amounts of data. It's going to be much quicker delivery to that patient. It will give us an enhanced customer experience. It's going to it's going to know everything about us, and it's going to personalize that experience much quicker, much faster, and much more in depth than a typical human can. Innovation, it will innovate using itself. It will be taught to think and innovate for us. That's a huge opportunity. When we look at when societies develop, take on new productivity gains, whether it was running water or whether it was electricity or the automobile or the internet or even a smartphone, it might have taken 100 years or decades to adopt that technology and that productivity game to make the human race more productive and better. It will not take decades or 100 years for us to all adapt to artificial intelligence. We are already seeing it in our day-to-day lives, whether we realize it or not. So that's going to be one of the quickest adoptions of technologies in the history of mankind. That's a bull market for equities and companies and industries and sectors who adopt this from a productivity standpoint. Are there risks? Of course there are. Valuations go out of control. And when disruptive technologies are introduced into sectors or industries, that can lead to asset bubbles. Okay, so there's a risk in terms of valuation. Does the internet.com boom, as we recall, does that happen again? Or can we avoid that by management of these risks? Regulation, governments, everyone can have a different view of this. Every government could say, we're going to put tough regulations on this. Our government can say, we're going to put zero regulations on this. But that's a risk. Ethical concerns, clearly, it'll be privacy, bias issues that we have to keep an eye on, competition. It's going to eliminate some competition that may deserve, may not deserve, but it'll allow that to happen quicker. The successful adoption of productivity gains will definitely affect the ones that have not been successful doing that. So there are risks. We're going to need a lot more semiconductors, that's for sure. And if we don't, they might get mad at us. That's a joke, of course. We definitely don't want the robots mad at us. But we're gonna need to produce a lot more technology, semiconductors and data centers, servers, to allow this to work. So there's a lot of opportunity here, investments. So there's my quick pitch on artificial intelligence, since people usually ask. Next page, please. Okay, it's an election year. So what's an election year if someone doesn't force us to put an election chart in our slideshow? So I put two of them in here just for fun. Again, does it affect investments this year? Who knows? Probably not, but it's fun to look at these type of things. So in a stock market, what has performed best? And if we look at from a House, from a Senate, and from the president, if we look at average returns of all of these things, what's the best and what's the worst? So the best happens to be when there is a Republican president, a Republican Senate, and a Democrat-controlled House. Happened 8 different times, 8 different years. And the average return over those 8 years in the stock market was 18.2%, which is a fairly high number, and it's 8 years. So it's a fairly long data set. That happened during years during President Ronald Reagan and President Trump. The worst was the -17. It only happened twice. Was when a Republican was president, Democrat-controlled Senate, and a Republican House. That was during George W. Bush's tenure for those 2 years, when there was a -17 average return over those 2 years. We all know one of those 2 years also. So fun exercise, might mean nothing this year. Number one is the opposite world of where we are right today, which is kind of interesting. But that's a return on the stock market. Next page. Ultimately, divided government probably means more than anything. So a little bit on fixed income. So since the Fed has kind of began targeting inflation, yields have peaked 11 months on average before the Fed starts to ease. So if we're starting to predict, and the market definitely is, when the Fed is going to begin cutting, whether it's in March or whether it's in June, fixed income yields peaked on average 11 months before that date. So if it's June, then the peak would have been last August, September. Well, that probably is a pretty date to look at, since they seem to have peaked on those two dates. If it's March, then we have to look past that, and it would have gone back to April to May of last year. So that's what we're trying to look at here, is when we look at if the Fed is going to tighten or the Fed is going to start cutting, when do yields peak? And we believe that yields have already peaked, and we've seen these numbers start to come down. That's a good thing for fixed income. Remember, inverse relationships on yields and bond prices. So if yields go up, the value of the bond goes down. If yields go down, the value of the bond goes up. So 2022, which was the worst bond market in modern history, the Fed did what? They raised rates the most aggressive they have in any time. Hence why valuations went down so much. So we are leading into a cycle where the Fed may be actually cutting rates. Inverse relationship, bond prices will move up. So we're very positive in fixed income. We're actually back to what income is. That's high coupons, and we have those. So we're very positive on fixed income going forward. Next page. U.S. Treasury bond returns have consistently been positive before Fed begins to cut, with larger returns on average before the first Fed rate cut than 6 to 12 months after. So what does that mean? That means returns do very well right before, and they still do okay 6 months, 12 months after. So these are average returns. So yield to peak to first Fed cut, on average, 11% return on bonds. Okay, that's excellent. Those are stock returns. That's the time frame where we could be in right now. 6 months after. So if they cut in March or they begin cutting in the summer, average return is 6% 6 months after that. We go 12 months after that first rate cut, if it's March or if it's June or whatever, 8% return on average fixed income after 12 months after that cut. So we have a nice, really nice runway ahead of us in fixed income if history likes to repeat itself, and if the Fed actually begins to do what the market is starting to predict that they're going to do. Okay, next slide, please. Okay, ugly slide, lots of numbers on it. Some are cheap, some are more expensive. This is the whole point of why you want to diversify. If we magically, on our own, pick one fixed income asset class, emerging market bonds, agency MBSs, investment grade corporate bonds, we might be right, we might be wrong. If we actually diversify our fixed income, whether we're using an active managed fund or we're using a diversified portfolio of multiple funds, we do much better. Some things are expensive, some things are cheap. Managing these when the spreads are moving, whether they're getting closer or they're getting further apart, that's the management in fixed income. That's what you have at FIP. Next slide, please. Okay, my second election slide. This is on fixed income. So same thing here. What is the average return? What's the best? What's the worst? And the data set behind it. So 8 years, we get to the best, 16.1 average return on the bond market. Number one, that's excellent. 8 years to get to that number. That was, again, during President Ronald Reagan, President Trump. The worst, President Obama, President Joe Biden, up and through, and again, calendar year 2023. Negative returns or very slight returns versus 16 or even 10. So again, divided government, President Republican, President Senate Republican, House is the Democrat, opposite where we are today. So both equities and fixed income, the best returns were in that historical context. Fascinating. Now, going forward this year, calendar year 24, who knows? Will it mean anything? Ed, who kind of our market strategist that designs this, who knows, means nothing, but it's a very interesting slide to see how, okay, who proposes bills? The House. Who argues for hours and hours over that bill? Senate. Sometimes they make it better, sometimes they make it worse. And then who literally signs the bill off what the House and the Senate has actually negotiated? The president. So best case, worst case, interesting that was the bond and the fixed income for best case. Divided government. So next slide, please. Always want to finish on the best slide, the most colors and the most numbers and the most. So this is our last slide. This is the multi-asset kind of Sharpe ratio. Sharpe ratio is one of those, Greek alphabet things, one of these statistical analysis that we do on funds. It's Sharpe ratio, is it worth it? Statistic. Is it worth to take this type of risk to get this type of return? So you really want to have a positive Sharpe ratio. And what this proves, other than being obnoxious and confusing with too many numbers, is if you own one of these asset classes, whether it's equities, whether it's commodities, whether it's a hedge fund index, whether it's an investment grade bond, you will have you will be last with a red, and you might be first with a green. But if you equally blend all of these asset classes, you will never be red. You will never be the worst risk-adjusted return portfolio. In other words, saying to yourself, boy, this was not worth taking that risk to get this return. That was not worth it. That's what we want to keep you away from doing. That's what FIP wants to keep you all away from doing. And by diversifying portfolios, owning a little bit of this, owning a little bit of that, you avoid low risk-adjusted returns or Sharpe ratio, and you can always look at yourself, see, it was worth taking that risk to get this type of return. Let's keep doing this. So
thank you so much. And thanks for the words of wisdom on the upcoming elections and what we should hope for. It looks like it's going to be a toss-up. Well, with that said, we will reserve questions towards the end. We want to bring on David Spagnoli, who is Associate Director at Wisdom Tree. And as you all know, Dr. Jeremy Siegel is also the advisor for Wisdom Tree Funds. So David will be introducing Dr. Jeremy Siegel.
Excellent. Thank you, Caroline. And thank you all for having us this evening. Really appreciate everyone's time. Really special guest tonight. He is a world-renowned economist, professor at Wharton, highly decorated. You may have seen him on CNBC, Fox News, quoted in the Wall Street Journal, Bloomberg. His famous book, Stocks for the Long Run, I believe it's on its 7th or 8th edition now, and very, very popular. I'd like to give it up for what we call the Wizard of Wharton, Dr. Jeremy Siegel.
Thank you, David. We are in the 6th edition of Stocks for the Long Run. David, not quite the 7th and 8th yet, but the first edition was 30 years ago. We have sold almost 500,000 copies. Quite proud of that. As you also see, Jeremy Schwartz, who's the global CIO at Wisdom Tree, and who is my best student, wrote, did a lot of the research, and I grant him that recognition, as you can see in the title of Stocks for the Long Run. The lawyers tell us we should put these slides in, so I'm putting them in, but I'm not going to read them. Let's look at the most important slide in the entire book. It has almost 800 pages of Stocks for the Long Run. And what do we have here? Total real returns from the beginning of the 19th century. How much wealth do you accumulate by starting out with $1 worth of stocks, reinvesting all the dividends? And all these asset classes, stocks, bonds, treasury bills, gold, and the dollar, are measured after inflation. So that's why they're called real returns. And I did almost 3 years of research to get this. And when it came off on this graph, I said, wow, this tells you the story. The stock line, of course, is the one at the top. You also see it is very volatile. It has all those little, peaks and troughs. Those are the great bull and bear markets over time. But you also see that in the long run, it has the most stable return. A straight line on a logarithmic graph means constant return. And over the entire 222 years that we have data for the United States, the average after inflation rate of return per year, annual, on stocks is 6.8%, dividends plus capital gains after inflation. More than doubling bonds, almost tripling treasury bills. Gold just barely stays above inflation, and our poor dollar is depreciated. Well, almost all of it, we got off the gold standard in 1930s, and then more and more, and we've actually depreciated. The dollar's worth less than 4 cents of what it could buy at the beginning of the 19th century. It's depreciated a total of 2,500%. Wow. Over the last 80 years, almost all of it since 1940. There's a couple things that are very noteworthy about this graph. When I finished the 6th edition about a year and a half ago, I went back to my first edition written 30 years earlier. And I calculated I looked back at what I calculated the real return was. And guess what? 6.7%, 6.75. In the last 30 years, despite all the financial crisis, the pandemic, you name it, the after inflation real return on stocks has remained between 6.5% and 7% per year. What persistence. Just quite remarkable. Secondly, and this is also very important, as I noted, and as you can see from looking at this graph, almost all the inflation we've seen, that depreciation of the dollar, has occurred in the last 80 years. You also note from the top that it has had no negative impact on stock returns measured after inflation. In other words, stocks in the long run completely compensate investors for inflation. That is very important. That doesn't mean that every year you're going to be compensated for inflation. Nothing can protect you every year. Yeah, maybe 1 year Treasury inflation protected securities, that will protect you. That's it, nothing else. But over the long run, one can see that stocks, being claims on real assets, factories, equipment, land, copyrights, trademarks, all that intellectual property, those are real assets. And real assets in the long run overcome inflation. So if you are worried about inflation in the future, and who isn't? Now, I think we've got this inflation tamed now. And I think the Fed should lower rates, but we'll talk about that. But, what about 5, 10, 15, 20 years out? Might there be another burst of inflation? Oh, yes. Especially with our deficit the way it is. What asset do you want to be in? You want to be in stocks. You want to be in real assets. If you fear inflation incursion onto your wealth. Okay. How did we get to where we are today? This is a graph of the money supply. And why do you say the money supply? Well, I actually got my PhD in economics at MIT, and then my first teaching position at the University of Chicago. in the mid 1970s, 1972 to 1976. And I was honored to be a colleague of Professor Milton Friedman, the father of monetary theory and policy. He taught me so much. One thing he taught me, I remember I had many lunches with him. He said, if there's a burst of money growth, you see here what's called M2 money growth. That's all checking accounts, savings accounts, time deposits, CDs, money market mutual funds, all that liquid asset. He said, if there's a burst of that, you won't get inflation right away, but 12 to 18 months later, you will get inflation. Now take a look at that top graph. Top graph is 2016 to 2021. We were going along at a money supply growth rate of a very normal rate, 5.3% a year, which just compensates for 2%, 2.5% inflation, 2.5% real growth. And then the pandemic hits, March 2020. We explode the money supply by 17.5% in 4 months from March to July. And then the Fed, for inexplicable reasons, continues to pump up the money supply at nearly a 12% rate for the next year and a half. I was lecturing to everyone saying, this is not temporary inflation. We're going to have a bout of inflation. And until the Fed gets that money supply under control, we will have continuing inflation. Well, they did get it under control late. Take a look at the right graph over there. You can see the big burst of the money supply and then the rise. And then in March of 2020, they started tightening dramatically. March of 2022, 2 years after the pandemic. And as a result, slowed the money supply growth. And that's what killed the inflation. Now, we should not have had that inflation had they not exploded the money supply. So before everyone just praises the Fed out of, they're saying, oh, how great is the Fed? We're going to have a soft landing. That's almost never been done before, blah, blah, blah. We should not have had the inflation we did. Chairman Powell, and the Fed were way too late in tightening. And by the way, take a look at the bottom graph, 50 years. The big inflation period, you have to be old enough like me to remember it, 1970, 86, we had money growth of nearly 10% a year in inflation that was 7.0% a year until Paul Volcker, if you know some monetary history, he raised interest rates to 16 to 20% and cut the money supply growth, and we finally killed the inflation. Very, very significant. And then we went 34 years with a money supply growth of 5.4% and moderate inflation and decent real growth. Just to show you how much money growth we have, I'm going to borrow from a chart that Professor Friedman himself compiled when in 1962 he wrote a book called The Monetary History of the United States and traced the money supply growth all the way back to 1871. That's a solid line. Inflation there is a dotted line, lagged 2 years. As he specified, inflation often lags. Do you see 2020? All-time record growth, 25.8%. Higher than any year that preceded it. Higher than World War I, higher than anything in World War II. And we had inflation that followed. Then he slammed down the brakes. I got worried. You see, that's actually negative, that final arrow, actually negative growth, which got me worried. But fortunately, he began growing the money supply again. We need to grow it some more, but I think he just stopped short of driving us into a recession. The other very negative growth period, as you can see, by the way, with the first red arrow there, was in the early 1930s. Documented by Professor Milton Friedman and described in his book, The Biggest Monetary Contraction in U.S. History, Causing the Greatest Depression in U.S. History. And this research won him the Nobel Prize in Economics in 1976. All right. What is one of the reasons why Chairman Powell goof so much and cause so much inflation in the Fed? Well, one is they weren't watching the money supply. He said, I don't believe the money supply has a big correlation with inflation. Well, I beg to differ. But another thing is that Chairman Powell and the Fed were following a faulty measure of inflation, particularly as it applies to housing. Now, housing or shelter is the most important and largest component of the consumer price index. It is, in fact, 41% of the core index. That's all items less food and energy. That is the index that Chairman Powell looks at when he judges the inflation rate. I'm showing you this here. You see something called BLS measure. What is that? That is short for the Bureau of Labor Statistics. That's the official government measure of shelter inflation. The actual rent index is the actual computations of renting 1, 2, 3 bedroom apartments in the United States, how much inflation you had. Now you say, well, just a minute, how did they differ so much? Because the Bureau of Labor Statistics, for reasons which are crazy, and I won't go into, only regards inflation when somebody rolls over his lease and has to renew it at a new lease. So if you have a 2-year contract and your rent is $1,500 a month, that's all they count, even though a new person might be paying $2,000. Now, they don't do that with anything else. Why they do it with shelter, I don't know. But as a result, the BLS measure, the government measure, lags dramatically, and it's the biggest component. So what does that mean? Let's take a look at the next one over here. It means that actual...
Either get better.
Excuse me? No, okay. Oh, we can have questions later on, and I'll be happy to help you. So what it meant was the actual rate of inflation started going up much faster than Chairman Powell and the Fed had been calculating. That's the blue line. The top segment here is total inflation, and the bottom segment is that core inflation minus food and energy. You could say total inflation hit a year over year of almost 13%, and the core inflation by 12%. But as you can see, it never hit those heights because of the lag. So inflation, they should have been warned about this much earlier. And you can see inflation is coming down dramatically. In fact, actual inflation right now, if you use current rents, is down to 0.6% on core and actual inflation, even though it's 3.9% core inflation, 3.3% actual inflation computed by the government. That just shows you the difference. So actually, in my opinion, they're already there, and they should be lowering rates. They've gone back to the zero inflation. Take a look at this. Wow. From the pandemic of 2020, all at the bottom, wages and consumer price index, they're all up by 20%. The wages lagged behind in 2021, but they've caught up. Now, you could say that's good. Well, that's not so good because wages usually rise by 1 to 2% more than inflation. So for 3.5, 4 years, we should have been 7 and 8% above. Just because they've caught up recently doesn't mean that it's been a good performance since March 2020. But this is what I think is very important. Home prices have risen, this is nationwide, 45%. And now, suppose you get an 80% mortgage on your home. How much has that gone up since the pandemic? 129%. The cost of buying 80%, 20% down payment, financing 80% of the average American home. Now, I'm sure that many people listening to my presentation we're fortunate, and you own your own home. So you're getting increases in equity, home equity. But we have to realize that 100 million Americans don't own their own home. They're renters. They want to buy their own home. They want to realize the American dream, but it's been priced out for them. Right now, if you're a young couple, let's say, starting out, unless you're in a very high income bracket, or you have very rich, generous parents, it is almost impossible now to buy the average American home. It would just use up too much of your resources. I think this is, a big source of discouragement among certain groups of people, because the American dream is to have your own home. And it's been priced out of existence because of the inflation and the monetary policy caused by the Fed. Inverting the yield curve. We don't want to invert the yield curve. This is long rates minus short rates, been followed by recession almost every time in the last 60 years, but maybe not this time. In fact, my prediction is no. I think we're going to have that soft landing. And why? The major reason is we did not have a buildup in inflationary expectations. All the talk that it was temporary, although it was wrong because it flared up, but that kept people saying, well, it's going to go down. And the fact that when he finally tightened, he tightened so strong, we never had the 1970s buildup of inflationary expectations. And that is a major reason why I think we can get out of this situation with no recession, maybe a slowdown, but no recession. Nonetheless, the normal shape is long rates over short rates, and that's what we should have. Interest rates went down for 20 years, from 1999 to 2021, and then bang, upward. Yeah, Fed had to tighten. But one factor is very important here in determining interest rates that is often ignored. This is a graph of the 3-year rolling correlation between stock and bond returns. Now, what does that mean? Well, this measures how good are bonds at diversifying your stock market risk. If the correlation is negative below that solid line, then it's a very good diversifier. And you want very good diversifiers in your portfolio. And the demand for bonds went way up, the price went way up, and the yield went way down. Bonds are great diversifiers for geopolitical risk, pandemic risk, financial collapse. However, they're bad in one set of risks: inflation risks. They're bad diversifiers. And you can see what's happened to the correlation recently. That is a major reason why bond yields have gone up. They are not viewed as good diversifiers as they used to be. All right. I have a number of things here, and for time's sake, I'm really going to summarize these. There's a lot of people say, oh, what happens if Fed doesn't cut as much as they thought? When Jay Powell held his meeting, what I saw was flexibility, that he would lower them if necessary. It didn't mean he had to lower them to support the market. Now, I think he will. But it may, I think tomorrow, there's a meeting tomorrow, and we're going to get the conference. I think he's going to go slow because the economy has been very strong through this higher interest rates. Actually, if you interpret the market correctly, I think the market is only expecting 4 rate cuts this year. I won't go into the details there. In December of 2023, the famous dot plot of the Federal Reserve indicated 3. So there's not that much difference between what the Fed thinks and what the market thinks. I do think the Fed must raise the money supply growth back to 5%. It is not there yet. And that entails lowering rates, increasing loan demand, stimulating the economy. When all is said and done, in a year or two, I expect the Fed funds rate to be down to 3.5% from the 5.3% it is today. And I expect the long bond, believe it or not, to be just about where it is today at 4. Upward sloping term structure of interest rates. Now, where are we at on the market? Well, a couple of days ago, the S&P was at 48.91, and that was selling at 20.4 times this year's estimated earnings. By the way, 212 is the 2023 estimated earning. Now, I actually think, and I've written on this, won't go into details, that 20 is the right PE for the overall market. Okay, but there's really two markets here. I will talk about that in a moment. But first of all, let me talk about what returns you can expect from markets that are selling for a little over 20 times earnings. If you take the reciprocal of the price-earnings ratio, in other words, earnings over price, you get a variable called the earnings yield. And that's an excellent predictor of real returns on stocks. So if you take 1 over 20.4, you get 4.9% after inflation. That's a little bit lower, but my 3 to 5 year expectation for how much stocks will give after inflation is about 5% a year. Now, this one time, there are really two markets. There's a value stocks, those that aren't growing really fast, and then there's those growth stocks that we all know, the Magnificent Seven, that are selling for almost twice as much price-earnings ratio as the value stocks. Let me go to the next slide, and then I'll come back to this slide in a moment. We here have graphed over the last almost 30 years the relative value of these value stocks, so those are low price-earnings ratio, high dividend stocks, relative to the growth stocks. Now, as you can see, the historical median is 70%. But right now, we're only selling for 57%. That means value stocks are cheap and growth is expensive. Is it the most we've seen? Oh, no. You see on the left the dot-com bubble in 2000. That we had about 38, 39%. That was a real bubble and it crashed. No, we're not going to have a crash here. But over the last 30 years, value stocks are cheap stocks. Let me bring something very interesting to you. I was watching the markets today, and right after the close, you know that a number of stocks reported earnings. We had Alphabet, Google reporting earnings. We had AMD reporting earnings. We had a number of growth stocks that were reporting earnings. Microsoft, actually, which is the most valuable stock, reported earnings. Every growth stock that reported earnings this afternoon beat the estimate, the official estimate on earnings. And yet every single one of them went down in the after-hours trading. There was one stock today that fell short of its expectations, Starbucks. And guess what? It went up after hours trading. Now, why? Because such high expectations are now built in to the Magnificent Seven and their cousins that you not only have to beat the estimates, you must beat the estimates by a gigantic amount to get anyone excited at these prices. While value stocks that aren't all that exciting, I mean, they don't grow as fast, you don't have to beat estimates. In fact, it was interesting, Starbucks actually fell short and yet went up. Now, that is an unusual circumstance, but it just shows you that you can't just be good, you have to be great and consistently great. One last point I want to make over here. This last one, a lot of people say to me, Jeremy, are you only saying 5% on stocks? No, I'm saying 5% after inflation. Yeah, I know you can get 5% on bonds today, but those are before inflation. Don't confuse the two. It's like apples and oranges. If you want to guarantee yourself against inflation, you must buy Treasury inflation protected securities or TIPS. Guess what you have for TIPS right now? 1.6, 1.7%. While I'm saying you'll get 5%. So there's more than a 3 percentage point per year advantage today, even at today's level. And by the way, if you buy value stocks, it's 4 to 5% advantage per year. You guys know the power of compound interest. You know what that would mean after 5, 10, 20 years or more. So, some people tell me, oh, stocks and bonds give the same today. No, they do not. They do not give the same today. Just want to show you, I'm wrapping up here, worldwide PE ratios of the major averages around the world. You can see over here, 2024, 2025, we have the Dow Jones at 18, we have S&P, as I said, at 20, we have NASDAQ at 28, we have Toronto at 14, we have Mexico at 12, we have Brazil at 7, and we have Europe at 12. Nikkei is a little expensive at 21. Take a look, S&P 100, 20.7, S&P 500, 20.1, S&P mid cap, 15.1, S&P small cap, 14.8. The worldwide level is what, 16? Let me just look at it. Yeah, 16.9, 14 on the basis of next year's earnings. These are very reasonable values worldwide. So, if I'm still, last year actually international diversification did not do badly. And I still think it will pay off for investors today. Let me end my presentation with a chart that I started with. The long run real returns on the major asset classes over time. If I were to summarize my book, Stocks for the Long Run, in one sentence, I would say the following. Stocks are the most volatile asset class in the short run, but the most stable asset class in the long run. Yes, trying times, bear markets, sell-offs, crashes, all those dips you see in that line occurred over the last 200 years. But they are mere blips in the upward thrust of values that beat every other asset class.
Thank you. Thank you, Dr. Siegel. Thank you, Brian. We have a couple of people that sent in their questions. One of them is sort of tangential to your talk. There was some intervention from the Fed last year when some banks faltered. They call it, I guess, a Fed put when the Fed intervenes. And I guess I'll open this question up to you, Professor Siegel, first. Do you foresee anything like that happening where the Fed will have to intervene fairly quickly? With that situation?
I think that you're talking about, of course, what happened to Silicon Valley and Bank around March of last year.
Right.
The Fed will always step in to prevent a general bank crisis. I do not anticipate anything like that this year. I think that a lot of, we know that the stock of financial institutions and mainly the small and mid-sized banks have gone down because of the commercial real estate holding, but I think they've taken their losses. I think interest rates are headed down. That is good for them. So I do not expect this year any sort of emergency Federal Reserve intervention.
All right. Great. There's a lot of discussion. Here's another question about you know, the older way of admitting, of evaluating stocks as value versus growth, which you've just discussed. And then looking at it as perhaps another way of profiling stocks is to look at those companies that have a high R&D component and those with a lower R&D component. And but looking at it that way, more innovation, if you will, as opposed to traditionally classify value versus growth.
Certainly, I mean,
what are
the
your
growth
thoughts on that?
stocks have higher R&D, there's no question. And growth stocks have done wonderfully, and they are wonderful companies. And you know that they've done extraordinarily well. But there are threats always. Then expectations, as I mentioned, are always high. They have to be met and exceeded. I mean, take a look at what's happening with Tesla. You know, quite a come down. It is one of the Magnificent Seven. We'll see what happens, but Elon Musk certainly sounded the warning of competition from Chinese EVs. Do not recommend or not recommend any particular stock, so don't take this as one way or the other. I'm just telling you that risks can come quickly to any stock. Can be political risk, can be competitive risk, or whatever. No stock is a sure thing. At one time, IBM controlled 75% of all computer markets in the 1970s. And now it's almost an also-ran, although recently it's done a little better. Nothing stays number one forever. One should never concentrate one's assets only in one group of stocks.
Carolyn, may I ask a question for the
Yes.
professor?
Yes, go ahead, Fred.
Professor, what would be your possible projection for market returns in 2024?
I have basically said that I think that it is going to be a good market, but not as good as last year. I think we're going to have positive returns. I think we can have 6 to 10% returns on the S&P this year. But one has to realize that the volatility, even on a yearly basis, is quite substantial. It could be -10 and it could be +25. But I actually think this is going to be a good year. I think earnings are actually going to exceed the 240 estimate that we see here. And I do not forecast any recession.
Okay, thank you.
Interesting.
Thank you.
Thank you. We have a question from the floor. Stephen Schneps has asked us, what's your recommendation? And Brian, also jump in so both speakers can give us your view. They probably won't be the same, which is why we have two speakers. What is a recommendation for a stock bond blend for an average 60-40?
Well, let me first answer that. We at Wisdom Tree, even before the pandemic, were calling for 75-25. We thought that given the low yields on bonds, that there was too much risk there and that stocks would be the better asset. It has proved to be the better asset clearly over the last 4 years, 5 years. And we still recommend it with threats of inflation, not this year or next, but over the next 5 to 10 years. Bonds pose some risk. Yes, you're getting much better returns, and that's one reason, because people know that. But, you know, if you're forming a really longer-term portfolio and you're worried about deficits and inflation going forward, I think that stocks are a better bet than bonds.
Okay. Brian, what are your thoughts?
Well, I agree with many of that. Long-term stocks have always outperformed inflation, hence why it is the asset class that most of us would recommend and favor. Short-term, sometimes there's timing, sometimes there's cycles. So short-term, the coupons that are available on discounted portfolios and fixed income. So we look at the path to 10%. Is it easier for a 6% coupon on a 94 discounted portfolio to get to 10%, where the cycle could begin this year, versus the S&P going to 10% return from today. It doesn't mean that S&P can't get to that 10% or double-digit return going for over the next 12 months. It just may be an easier path for a bond portfolio with a 6% starting coupon on a currently discounted asset class. So in a diversified portfolio, short-term fixed income, if we see the economy slowing, if we see the Fed taking reaction to that, if we see politicians who like to get reelected in an election year take action to take credit for a wonderful economy, that bodes well for a lot of different asset classes. And so short-term fixed income is the obvious answer. Long-term equity is the obvious. And as we said, the dividend bias. And it kind of goes into that research is companies are plowing a lot into research. They're generally not plowing a lot into a dividend currently. Doesn't mean they don't initiate or grow a dividend in the future, but a 40-year track record on the S&P, if you take out the dividend growers and initiators, we've got a double-digit return over the last 40 years. For a equally rated return on the S&P, you've got 7.5 non-dividend paying stocks. You're at 4 with more risk. So that's the other way we look at equities and maybe lower risk equities in a declining economic activity where the Fed's clearly going to do something different this year. Maybe a good play to build a balanced portfolio.
Yeah, I
Okay.
agree with Brian. If you find very good, I mean, there's some good credit. If you don't fear a recession, some of the lower quality bonds, not the treasuries, are giving some pretty fat yields that you could do very well with at the current time. Yes.
Okay. All right. Well, hopefully that helps answer your question, Stephen. Well, I think that kind of wraps up some of the questions we have right now. I wanted to, I think, Brian, you kind of answered one of the last questions we already had in your last answer. So I think we don't have to go through that one. Any final comments from Brian or Dr. Siegel?
No, I think we've summarized. I didn't hear all Brian's earlier talk because I came in the later. Actually flew in from Florida back to my home in Philadelphia. But I'm pretty optimistic this year, and I know there's going to be a lot of events, political events, and others going on. There always are. But one thing we should always remember: there's an old saying on Wall Street. Stocks climb the wall of worry, which means that if you wait until the skies are blue and there's no clouds before you invest in the stock market, you will be buying at the very top.
Okay, that's a takeaway. Well, I wanted to thank all of you for participating and for everyone for coming on tonight. I also I'm going to hand the floor over to Harry, who will give us some closing remarks.
Thanks, Carolyn and Michael and Dr. Siegel. And Brian, appreciate your comments. Very helpful, informative. Nice to be reassured that things are looking positive this year. We say we're cautiously optimistic, but it's important to stay in touch with your advisor on a regular basis to keep things on track and to plan for withdrawals or additions. So again, if you have any questions, please contact us. We're available anytime. That's one of our uniquenesses. Anytime, and that all of our people should have an updated plan so that they're confident that they're on track regardless of short-term volatility. So appreciate you as clients, and hope you all have as I mentioned earlier, happy, healthy, and fun new year. Thank you, Dr. Siegel. Thank you, Brian.
Thank you, Harry.
Thank you, Harry. Thank you all.
Good night.
Good night.
Good night. Thank you.